Most traders cannot see the market clearly because they never learn to filter noise from structure. They react to every tick, every candle, every meaningless fluctuation, and then they wonder why their results remain inconsistent. They are not losing because the market is difficult. They are losing because they refuse to remove the distractions that distort their judgment. Noise is anything that does not all the underlying trend. Yet, you treat all movement as significant. You assume every dip matters, every spike matters, every indicator shift matters. This behavior is not analysis. It is desperation. Charles Dow separated the market into primary trends, secondary reactions, and minor fluctuations, and unless you understand this hierarchy with absolute precision, you will misinterpret the market at every turn. The reason most traders fail is psychological. They want certainty in an environment that only offers probability. They want every move to carry meaning. They want to believe that noise is information because it feels safer than admitting that they do not understand trend structure. I need you to accept that noise exists, and until you learn to ignore it, you will continue to sabotage your results. Dow's entire system begins with the recognition that price reflects consensus. When you ignore the structure beneath price, you stop observing the market and start projecting your fears onto it. That is the source of your errors. If you do not correct this flaw, you will never progress to the deeper layers of Dow's method, but we will get there only after dismantling your current misconceptions. Here is the first principle you must internalize. Price discounts everything. Every known fact, every expectation, every institutional action, and every collective belief is embedded in the price at all times. You do not possess information superior to the market. You are not ahead of the crowd. The tape already reflects what you think you discovered. Most modern traders violate this principle daily. They search for reasons to validate trades instead of observing the tape. They cling to opinions and predictions, as if the market will move to accommodate their expectations. Dow's principle is absolute. The market does not care about your interpretation. The market reflects reality whether you understand it or not. Price knows before you do. It knows before the news. It knows before the analyst upgrades. When you trade based on external commentary, you trade the past. When you trade based on opinions, you trade fiction. A trader, guided by predictions, is a trader fighting the entire weight of market consensus. The psychological flaw is arrogance. Traders believe they can see what the market does not. They assume they have insight that has not yet been priced in. This is delusion. If price is rising, the market is voting higher. If price is falling, the market is voting lower. Your belief does not override the collective judgment of millions of dollars. The modern application is simple. Anchor every decision to the direction of price, not to the story you prefer. If price contradicts your opinion, abandon your opinion. If you insist on defending it, then you are not a trader. You are a gambler disguised as an analyst. You want clarity? Remove your interpretation and observe the tape. That is the beginning of discipline. Dow divided market movement into 3 categories. Primary trend, the major direction. Secondary reaction, intermediate counter-trend movement. Minor swings, intraday or short-term noise. This structure is not optional. It is foundational. Your inability to separate them is the root of your confusion. A primary trend is the broad movement driven by institutional conviction. It lasts for months or even years. It is true direction of the market. A secondary reaction is a temporary move against the primary trend, usually lasting weeks. Minor fluctuations are meaningless. They distract beginners and mislead undisciplined traders. The majority of your mistakes come from treating minor fluctuations as secondary reactions or secondary reactions as reversals of the primary trend. This misclassification destroys your decision-making. When you fail to identify the primary trend, you violate Dow's most practical principle. Trade in the direction of the primary movement until the market proves it has changed. Not when you feel nervous. Not when the candle is red. Not when an influencer says the trend is over. Psychologically, you want trends to reverse because reversals feel dramatic, exciting, and potentially profitable. You want the bottom tick or the perfect top. This desire corrupts your judgment. Modern application is direct. Identify the primary trend using weekly and daily charts. Filter out minor swings. Treat intermediate counter trends as temporary unless proven otherwise. Allow the primary trend to continue until it breaks structure decisively. If you cannot obey this hierarchy, then the rest of Dow's system will be useless to you. The primary trend is the market's dominant direction. Uptrend, higher highs and higher lows. Downtrend, lower highs and lower lows. No exceptions. Your job is not to anticipate a trend reversal. Your job is to recognize the existing trend and align your trades with it. Traders lose because they attempt to predict the end of a trend instead of participating in it. Dow's instruction is mercilessly clear. A trend remains in effect until the market proves a clear reversal. Modern traders violate this every day. They see a small pullback and declare the trend broken. They see a single candle and assume a new direction has begun. This is NAV. The primary trend remains intact despite numerous secondary reactions. The psychological flaw is impatience. Traders cannot tolerate being early in a movie or late in an exit. They want perfect timing. Perfect timing does not exist in Dow theory. Confirmation matters more than early entry. Modern application requires recognizing structure over emotion, requiring confirmation before declaring a trend reversal. Avoiding counter-trend trades unless you accept inferior probability. If you trade against the primary trend, you trade against the highest conviction participants in the market. You will lose. The market does not reward defiance. Secondary reactions are counter-trend moves that confuse traders who refuse to understand Dow's structure. They are not reversals. They are pauses. The reason secondary reactions exist is simple. Profit-taking, temporary sentiment shifts, and market digestion. You misinterpret them because you treat any opposition to your position as a threat. You respond emotionally instead of analytically. Dow rejected this mindset because it leads to reactive decision-making rather than trend-based execution. A secondary reaction must meet specific criteria. It must retrace a meaningful portion of the prior movement. It must last longer than minor fluctuations. It must occur within the structure of the primary trend. If these conditions are not met, the move is noise. Modern traders confuse small dips with major reversals because they want confirmation too quickly. They want the market to behave predictably. This is not how trends work. Modern application. Expect secondary reactions. Do not allow them to break your discipline. Maintain your trade as long as the primary structure remains intact. Your inability to endure these reactions is psychological weakness disguised as risk management. If you misinterpret temporary movement as structural change, you will never capture meaningful trends. Minor fluctuations exist solely to mislead undisciplined traders. They look significant only to those who lack perspective. Dow ignored them. You react to them. That is the difference between structured analysis and emotional trading. Minor fluctuations represent intraday volatility, algorithmic noise, random shifts in order flow, meaningless short-term patterns. If you base decisions on this level of movement, you are not analyzing the market, you are gambling on randomness. The psychological flaw is fear. You want to feel in control. Minor swings give the illusion of activity and the illusion of information. They are neither. Modern application is simple and non-negotiable. Do not analyze minor fluctuations for trend direction. Do not let minor swings influence your stops or entries. Anchor yourself to the primary and secondary structure only. If you cannot ignore minor fluctuations, then the market will punish you until you learn. Dow insisted that price must be confirmed by volume. If price moves without volume expansion, conviction is missing. If volume contradicts price, the move lacks durability. Modern traders rely on indicators that obscure this truth. They track signals divorced from the relationship between price and participation. This is a mistake. Momentum must be supported by activity. Volume tells you whether the market agrees with the price movement. If price rises and volume expands, the trend is supported. If price rises on weak volume, the move is fragile. You must stop treating weak moves as reliable entry signals. The psychological flaw here is wishful thinking. Traders want price movement to matter even when the market shows no conviction. They ignore volume because it contradicts the outcome they desire. Modern application. Evaluate volume on breakouts. Confirm trend continuation with expanding participation. Disregard moves that occur on low volume unless structure validates them. Volume is not optional in Dow's system. It is validation. If you continue to ignore volume, you will continue to misjudge the strength of every trend you trade. Dow used averages to confirm market direction. Industrial average, rail average, both needed to align. The principle remains. Strength must be confirmed across the market. Modern traders obsess over single tickers, isolated sectors, or narrow time frames. This is incomplete analysis. You cannot declare strength in a vacuum. A stock moving up in a weak market is usually an illusion strength built on fragile ground. The psychological flaw is narrow focus. Traders look for exceptions because exceptions feel special. Exceptional trades rarely sustain themselves. Modern application. Compare your ticker to the major indexes. Require alignment between your trade and the broader market trend. Do not treat isolated strength as confirmation of anything meaningful. Broader alignment is not optional. It is structural. Dow understood this. You must follow it, or you will misjudge the market repeatedly. Modern trading is saturated with myths that Dow's method obliterates instantly. Here are the major ones. Myth 1. You can predict reversals with extreme precision. Dow rejected this. Reversals requires structure, not prediction. Myth 2. Indicators outrank price. False. Price is the only truth. Indicators derive from price, not the other way around. Myth 3. Small time frames offer greater control. Incorrect. Smaller time frames offer more noise, not more clarity. Myth 4. You can beat the market through speed or reaction time. Nonsense. You win through structure, not reflexes. Myth 5. Opinions can override market structure. No opinion outranks the tape. The psychological flaw behind every myth is ego. Traders want shortcuts that spare them the discipline required for structural analysis. Dow built a system that exposes ego as the enemy of consistency. Modern application demands that you reject these myths completely. If you cling to them, you will remain in the 90% blinded by noise. You cannot become a competent trader until you separate noise from structure with absolute discipline. Dow provided a system that filters randomness and reveals direction. Price discounts everything. Trends have hierarchy. Volume confirms conviction. Averages reveal strength. You have ignored these principles long enough. If you continue to trade without structure, you will continue to mistake noise for information, and the market will continue to exploit that weakness. Now that you understand what blinds 90% of traders, the next concept will determine whether you rise above them. You must learn the exact conditions that prove a trend has reversed, not merely paused.